Hey everyone, welcome back to Yuri's Box. In this video I'm going to be looking at the S&P PMI reports for the month of April. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I could end the video right here by saying, what did we see in this report? More of the same. See you next time. Okay? Because if you've been following the PMI reports, my speculation was that February marked kind of the inflection point, meaning that what we saw in the PMI reports for the month of February was something that was less akin to a strong economy like we saw from September to January, and something that was more similar to what we saw from June to the middle of September, meaning that we should actually have to flip our concerns from inflation to growth. And ever since the February PMI reports, we haven't really seen any definitive answers, all right? We did get a bump in the month of March, but that was mostly because it was things kind of looked better compared to February. It wasn't really anything structural changing. It was just that March looked kind of a little bit better than February. But if you actually read the report, it was more of the same, just as April's report. US business activity growth slowed. Business expectations about the year ahead also dropped. We're here, output and demand. The fall in the index signals a deceleration of activity growth. Growth of service sector business activity slowed sharply to only a modest pace. When looking at future sentiment among companies about their output over the coming year fell for a third consecutive month, and also service sector optimism also cooled. And this is something I'll actually touch on a little further. Employment, although a modest increase, a net increase in payroll numbers was recorded across the service sector in April, manufacturing jobs were cut for the first time since October. And when I read this kind of first, when I read it for the first time, this paragraph on employment, I put my historian hat back on, and I went back and thought. The first thing that it reminded me of was actually September and October. In September, we had something like 200K non-farm payrolls announced. And before that, we actually came from 2 months of relative weakness. All right. Now, I'm talking about the first headline numbers, not actually the revised numbers. So for the month of July and the month of August, we got somewhere around 110 and 140. That was the first number that got announced, which were both misses. September comes around and we get 200K. As October comes around, we get 12K. Let me actually bring this right up. Although I do believe that this will probably have the revised numbers. So right here, September 223K, and we actually, 89K, yeah, these are the revised numbers. This was something like 113K, 114K, and this was 140K, if I'm not mistaken. But in any case, we came from 2 months of weakness and a convincing number in September, only to fall back to, and actually this was 12K in October. The setup is similar, in my opinion. We actually have 2 months of weakness. All right, we have 125K and 117,000K on for January and February, with 228K, which is a convincing number. All right. And again, the setup is quite similar, where we have 2 months of strength and then just a complete flush. Now, I'm not saying necessarily that is what we'll see. I'll, mull a little bit more and come up with my own personal estimate for what we'll see in a week's time. But if what we have read, both in this report and we'll continue reading in this report, and what we've seen in things like the Philadelphia Fed Business Outlook Survey, again, it's more of the same. Employment index registered a near zero reading, basically meaning not contraction, but minor gains, which could be consistent with a basically somewhere between, let's say, 20 and 70K on non-farm payrolls next Friday. But again, that's a topic for another video. Moving on, prices again were rising and linked mainly to tariffs and labor costs. And actually, there's a piece of commentary right here. It says tariffs are meanwhile being cited as the key cause of higher prices. And actually further elaborates right here that these higher prices will inevitably feed through to higher consumer inflation, limiting the scope for the Federal Reserve to reduce interest rates. Now, I've been pushing back against this idea. I believe that this is really the consensus view of things, that, even if we go into a recession, or, interest rates won't be able to come down, or the Fed won't be able to cut. I'm simply of the idea that given where we are, meaning that the economy isn't as strong as it as it was at least in 2022 and 2023, it didn't have a lot of tailwinds it had back then. Any bout on inflation is likely to cause further contraction in growth and consumption. And again, just focusing on the consumer for a minute, if something like the quits rate again is to be believed, people are not quitting the job on a voluntary basis, meaning that they don't have the leverage in the labor market, meaning that we will likely see stagnant wage growth, which will likely feed again into consumption. And again, if you don't have wage growth keeping up and really going higher, moving higher at a sustained pace, what you end up doing is just spending more money for the same amount of goods. It's just not good for the consumer. So eventually, and again, this is an ongoing process. We're not likely to see. I still maintain the view that we're not going to see some kind of a collapse from month to month, but it'll be a process, and eventually we'll get to a point where we'll have to really start considering the effects that all of this is having on the economy. Moving on to the manufacturing side, more commentary right here. PMI data for April was accompanied by a slump in optimism about the outlook. Manufacturing is broadly stagnating, and confidence about business conditions deteriorated sharply. Again, this isn't anything new. I mean, you could basically do a copy and paste for the month of April, and you basically get the same thing ever since February. Again, what is missing for now is, again, the so-called smoking gun. We still don't have something that you can definitively point towards to say, that's it. Like a bad non-farm payroll report, a bad unemployment report, something. All right, we have these kind of surveys on the business side. We have some mainly consumer surveys are in the dumps. Yes. But everything else is still holding up quite well. Again, we'll see how things evolve. Now, going into the PMI report, I pointed towards the possibility of this being actually a news failure on the dollar, meaning that even in the case of a weak report, we could actually see the dollar move up. And why would that be a news failure? Well, because, I mean, again, if you see a weak report and the PMIs, weak numbers mean weak economy means lower rates mean weaker currency. But I speculated that potentially we could see, again, a news failure, meaning that instead of seeing exactly lower rates and meaning a weaker currency, we could see the opposite. All right. And I didn't even consider lower rates yesterday. I just looked at the dollar and said, what if we get a higher dollar? Now, can you really say this is a news failure? It's 50-50 because, I mean, it wasn't really a news failure. I mean, to say it was a news failure, you would have to have had, in my opinion, something worse. Like a 50 handle on services and perhaps a 48 handle on manufacturing. And if you had this kind of a move right here on the dollar, then yes, you could absolutely say that was a news failure. Again, I'll leave that to the pro traders to determine whether it is or not a news failure. Overall, what you can say is that this report was a miss. It definitely wasn't a strong report. It wasn't anything, a blowout number. It was a miss. All right, and I was expecting a miss, but again, nothing too dramatic. We didn't get anything too dramatic. So far, again, the trade potentially worked. All right, but I'm not really too concerned about short-term movements. And again, if I, I don't. There's a reason why I don't give them out so many times, is because I know that I'd miss most of them. So, but again, that was just a little fun bit of forecasting right there. So how did things react? Well, bonds kind of retraced a little bit. All right, we were down about 3%. Yes, as you can see right here, we were down about another 7 basis points. I'm pretty sure Besant is talking right now. But overall, if we had a bad report, meaning maybe a 50 handle, a 49 handle on services, 48 or 47 on manufacturing, this move would have stuck and it would have actually potentially gone even further, in my opinion. The fact that it was a bad report. I mean, it was a miss, all right, but it wasn't anything tragic, so nothing to get too excited about just in the short term. I think that right now we're just really pricing the fact that we got the fact that Trump isn't going to fire Powell. Anything over, I'd say, again, this wick right here would have been a pricing in of a weak PMI report, which again we didn't get. So that's the state of bonds. The dollar is actually catching a bid, and euro is selling off. Again, I'll leave that to the pundits to decide whether that is a news failure or not. Oil is selling off. I think that is related to some OPEC news, and stocks are having a good day overall. Where does this leave us? Well, it doesn't really do much in telling us where we're headed. I think it's still more of the same, meaning that is a slowing economy with the added weight of tariffs and tariff uncertainty, and the fact that we continue to have at least some initial form or weak form of fiscal tightening. And again, nothing drastic by any stretch of the imagination, but it isn't the fiscal. You don't have the fiscal impulse to say that we saw under Biden. I mean, when I talk about fiscal tightening, I've made myself clear on what I mean by that in my previous videos. Doge and everything. I think the best thing that we have as far as fiscal tightening is concerned is hiring freezes until July, right? And that is saying a lot. All right, that's why I have this kind of a skeptical approach towards fiscal tightening. But again, it is in its initial phases, and we'll see how things evolve. But at the very least, it's not adding fuel to the fire, or at least just yet. All right. And as long as these things continue to linger, and again, we do have some positive news come out from the on tariff side. We have, the fact that tariffs might be coming down, yes, but we still have 10% tariffs on everything. All right, we still have tariffs, and as I pointed out, when we had the first round of the trade war in 2018, it actually took at least 5 months before we got to a deal. I'm not saying it's going to take 5 months this time around. All I'm saying is that it's been, again, 2 weeks, and again, you kind of get the sense that it's kind of everybody's kind of dragging their feet. But again, as far as the tariff drama is concerned, I've made my thoughts clear on that as well, even this morning. I just think that as time goes by, we'll leave the tariff drama behind us, meaning that headlines on tariffs will be less and less important, and we'll actually be forced, as time goes by, to really consider the state of the economy and the fundamentals of the economy. And just looking at the PMI report today, I mean, it does nothing to to enforce optimism. Does it tell us that we're in a depression? Absolutely not. It just tells me, at least, that we continue to see an economy that has come out on the other side of that. I would call it artificial, quote-unquote, strength that we saw from September to January, where the economy was affected by a lot of transitory events. And now we're on the other side of that, potentially. And we're in a place that is more consistent with June, July, and August, and the first half of September, potentially. And again, we'll just have to see how things evolve from here. The report overall is basically a copy and paste of what we saw in the previous months. Optimism is down. Outlook for the future is down. Things seem to be hanging in there still, at least for the time being. We'll see how things evolve. Now, the way I use the PMI reports is actually to extrapolate potentially the next non-farm payroll report. Okay, I'd like to see what if we actually do have an estimate. Not yet, not even Trading Economics. We might get one the day after tomorrow. Again, if you had to point a gun to my head, given everything we know, meaning that all of the regional Fed surveys have been weak. We've seen, even the PMIs today really not point to much strength. I mean, not contraction by any means of the not by any stretch of the imagination, but definitely not strength. All right, even that little bit of strength that we saw in March, you don't really see it. If you had to point a gun to my head just right now, I would potentially say somewhere between 20 and 70. But that might be a bit too pessimistic. Again, that's just you pointing a gun to my head and me just giving you a number between 20 and 70k. But I'll come up with another forecast. I'll try and see, try and go over all the reports and see in detail what we have actually, because you do have reasons to believe that could be a weak report, but also some potential evidence of a strong report. I'll come up with with something in the next few days, hopefully. I guess I'll leave it at that. Again, just to summarize, PMI reports weren't that great. I mean, it was more of the same, copy and paste of previous reports. And services was a miss. Manufacturing beat by a bit, just by a little bit. And again, more of the same. Lower optimism, dimmer outlook, and employment barely hanging in there, right here. If you like this kind of content, consider leaving a like and subscribing, and I'll see you next time. Bye.